I think the pandemic and the post-pandemic period created a lot of humility within central banks globally, including the Fed. And so I think that's probably made them a little bit more cautious on pounding any proverbial fists on the table in terms of where they're going with policy. Stick to the data releases. If inflation stays on track, if growth moderates softly, wonderful, we can get some rate cuts this spring. And if it doesn't happen, the Fed is allowed to change its mind. I think that's what Powell is getting at. But I think to the degree there was waltzing yesterday, so to speak, it largely is a reflection of what happened in the last few years and them realizing how complicated this particular economic cycle is.
And Rebecca, the market seems to have heard what the Fed said yesterday. If you look at the WIRP function, the WIRP go, in the March meeting, there was a 50% odds of a rate cut. Now that's down about 35% or so. So it seems like the market's getting the message. Is that kind of your take as well?
Yes and no. I mean, obviously the pricing in of March down, pricing in of May up, now about 93% odds of a cut in May. What was striking to me, though, is when we look at what's priced in for Fed funds today versus before the meeting, is we still have about 150 basis points of easing priced in for this year. That hasn't changed really since before the press conference. So it's just getting compressed into a shorter time frame. And I still am skeptical about that. I think you would have to see a lot of things go really perfectly right to get that amount of easing and get the double-digit earnings growth that's still priced in for the S&P this year.
Rebecca Patterson with us, our tech analyst this morning. Rebecca, I looked at the operating cash flow of Microsoft yesterday, and this is with your tour of duty at JP Morgan years ago. I think we really don't understand the size, the scope, the scale of Fortress Diamond, or frankly, Fortress Satya Nadella as well. Apple Computer today, pre-pandemic, they had $59 billion in free cash flow. Paul, basically they've done a double.
Yeah, sure.
I mean, in like 4 or 5 years. Do we understand the size of these companies, Rebecca? And how can we not own them if they're that dominant?
I think you have to own them. The question is, are you underweight, benchmark weight, overweight? And with the valuations today, with the expectations for growth, as we've seen in the last few days, any disappointment versus what's priced in the earnings season gets some profit taking. But if you take a longer term view, and I try to on these things, I'm not day trading, with that free cash flow, with the comparative advantages they have, the moats they have, the technology, the personnel, comparative advantage, whether we're talking tech or you mentioned JP Morgan, I would argue they're in that camp too. It's very hard to see them taken down. Now, this year, as you know, we're going to have some regulatory hurdles for some of the tech stocks, which probably don't end with a decision. They'll go to the court. So it'll drag out for a while. But that could be another impetus for some profit taking. I'd say if you get that kind of profit taking on the tech stocks, it's an opportunity to buy for a longer term position.
How do you feel about, we're right smack in the middle of earnings, Rebecca. How do you feel about what you're seeing here in earnings and what we're hearing from companies? It seems like the technology sector is still in pretty solid shape, but some of the others are still very cautious.
Yeah, well, we've seen that divergence in the economy over the last few years. If you look at the business sentiment surveys, the PMIs, we've seen a manufacturing sector that, reflected in those surveys, has been modestly contracting for 14, 15 months now. And the service sector, while strong, has been moderating. And so it's not surprising to me if you look across companies and sectors, you are seeing a difference between services, manufacturing, and then even within subsectors. And I think that's likely to continue.
Rebecca, we got to go to your wheelhouse, which is dollar currency analysis and that. What does the strong dollar, the resilient dollar, what does that signal?
Well, in the last 24 hours, it's simply a reflection of the March rate cut being pushed back, so higher short-term interest rates.
But I mean, in the last 6 months, the last year, it's been extraordinary how we've seen resilient dollar and underperformance of international equities. It's just been absolutely stunning.
I agree with you, Tom. You have to remember that compared to when we started our careers and trade flows were the dominant cross-border flow, today it's capital flows. And where does capital go? Goes where growth is stronger and ideally where valuations are attractive. Right. Now, U.S. valuations, we can argue, are not so attractive, but growth is so much more attractive in the United States versus the rest of the world today, by and large. Money keeps coming here, and that keeps supporting the dollar and U.S. stock markets.
Sounds like Bob Sinch from years ago at Bear Stearns. Okay, Bob Sinch or Rebecca Patterson, great, except the great destabilizer is Japan. If we finally get Japanese yen instability, what does that mean for our YouTube viewers in America?
Japan has been one of the few overseas developed markets outperforming the U.S. of late. Based on reflation, better growth, stronger inflation, but not too strong. And now the question is, if the Bank of Japan pulls back from that aggressively easing monetary posture and you get a stronger yen, does that undermine exports in Japan? That's been a big engine of growth and a big engine of the reflation for that economy. So the stronger yen on the back of less easy monetary policy, higher yields, to your point, we don't know how big a destabilizer that could be. It certainly could pause the equity rally there for some time, again, underscoring the attractiveness of being in U.S. large caps. But I think it's going to, Japan has shown that they're going to be very incremental, very slow about this. The last thing they want is a disruption.
Yeah. Rebecca, just real quickly here, geopolitics front and center, of course, for global Wall Street. How does that factor into your outlook here? Do you buy some gold? Do you try to hedge it? How do you do that?
I do think a small allocation of gold, and I'm talking about in a portfolio, probably something between 2 and 5% of the total, is a good hedge, not only against geopolitical risk, but also the possibility that we have a harder landing. But I think in the case of geopolitical risk, what you always have to ask is, if this risk becomes reality, does it have a material impact on my view of the economy globally or in that region? And does it have a material impact on markets? Why the market doesn't react is because so far it doesn't change your broader economic thesis. If we do see that change, then the geopolitics will matter a lot. And unfortunately, it's the sort of thing that happens quickly. So you have to plan ahead. You have to do your scenario analysis now, because when it happens, you don't want to be reacting with the market moving against you.